Hi, I'm Jonathan Treussard, and welcome to Treussard Talks, where we talk about the mechanics of investing, the psychology of investing, and what it means to manage your wealth with purpose. Because understanding your wealth shouldn't be as complex as building it. Welcome to today's show. Alec Crawford, thanks for doing this. I'm so excited to talk to you.
Hey, Jonathan, great to see you. I haven't seen you in person this year, but looking forward to it.
This is going to be super fun. So you and I met, like all long-lasting professional relationships and personal relationships, we met in a hotel room in New Orleans, Louisiana. I was a poor student looking to make some money. I know how we got here, but tell me of how, the story of how we met.
Yeah, so that was great. So I was working for Zip Brothers Investments. We were looking to hire a couple of PhDs in finance to help us in risk management. And obviously we're going down there for a conference to interview a ton of people. And it was kind of, speed dating basically, right? We would interview 10, 12 people a day. And I think that the funny story about that day was that morning I'd gone to Café du Monde and bought a bunch of coffee and beignets. And I got to say, the first beignet in the bag was freaking amazing. Probably the best donut I've ever had in my entire life. And then we're offering them to our interview candidates. It's coming, hey, do you want a beignet? Right. And of course, you were disguising your food poisoning and you're like, oh, no beignet, thank you. Right. But in reality, what was happening is in the first hour, they're amazing. And the second hour, they're like a reasonable donut. In the third hour, they're hockey pucks. Right. like they basically dry out and become hockey pucks. I'm like, oh, my God. So we basically had a couple hockey pucks left in the bag later, but that was the story of how we met.
Yeah, and I don't remember exactly where I was in the lineup, but again, I had gone out for dinner the night before with my father-in-law, Tzvi Bodie, and a bunch of finance honchos, people like Paul Salman, who's the economics correspondent on the PBS NewsHour. Bob Merton sat across from me at the dinner table, and I'm pretty sure I had a bad stew because the next day was not a good situation. So we met. I was just finishing my doctorate, and I think it was literally the first week of 2008. And you were looking to build out the risk management team. And I was one of three newly minted PhDs who joined you at Zip Brothers Investments. And I remember joining the team on June 15th. And you came into my office that day and you said, hey, the first couple of weeks, we're going to take it easy. You can make sure you know how to use the computer, the phone system, This is, know where the restrooms are. And I think within 2 hours, you were back in my office being like, okay, so I think we've got some work to do. So that was, that's how it all started.
Welcome to 2008, right?
Exactly right. Not a lot of intro time. So that's how we met. That was so many years ago. But again, selfishly, I want to go back to before that. You grew up in New York City, is that correct?
Yeah, I grew up in New York. I went to boarding school, went to Groton for 4 years, which was great and helped me get into Harvard. And at Harvard, it was a kind of interesting story. Like I always knew I wanted to do computer science, right? And when I got there, they didn't have a computer science degree, right? You had to do applied math or electrical engineering. So I took all these classes and engineering and applied math and even some graduate level, like very theoretical, computer science classes, things with pumping lemmas and Turing machines and all that stuff people are still talking about today, but it was not very exciting for someone who just loved to program. And then I got a call about 2 weeks before graduation. I've been working on my thesis. I was building neural networks from scratch and fun stuff. I'm like, and this is a call that every student dreads. Oh my God, the registrar's office is calling me with 2 weeks to go. I must be missing credits. I'm not going to graduate. Like, and they called and they said, hey, is this Alexander Crawford? Yes. What do you want on your diploma? I'm like, summa cum laude? But they're like, no, not that. What we really meant was you can choose what you want to graduate in. You have enough credits to be in computer science or electrical engineering or applied math. You get to pick. I'm like, oh, all right. Well, in that case, I'll take computer science because it's the first year that they're allowing it on a diploma. So that was pretty cool.
That's incredible. So you might have had one of the first Harvard degrees in computer science printed out on a piece of paper.
Oh, I do. It's to the right of my desk right here. I'm looking at it right now.
Oh, that's incredible. Okay, so and obviously this passion for computer science has come back full circle. But before we get to that, you ended up not going into computer science in the traditional sense of the term. You ended up having a long, and I should say distinguished career on Wall Street. So tell me more about that.
Yeah, it's interesting. I mean, I was like a computer whiz kid, right? I got a TRS-80 in 1979, taught myself to program, wrote some software, literally was working for broker dealers when I was a teenager, like doing stuff that no one knew how to do with computers. It was fun. But by the time I got to probably sophomore year, I was like, maybe junior year, I was like, you know what? I don't want to go into technology. I want to go into finance and use computers to do finance, like quant before anybody but Jim Simons had it figured out, right?
Right.
So that was my plan. And I'd always been interested in finance. Like I was like, a kid, like 11 years old. I'm watching like Wall Street Week with my dad and my godfather. And like, Dad, tell me what beta is, right? Like, he was like, what? Like, so those have both been my kind of twin passions over time. And so I ended up, actually really interesting. I ended up working I actually did have offers from a couple of the big tech companies at the time, which I turned down, and went to work at First Boston, which at the time was one of the two kind of premier investment banks in New York focused on fixed income. Mm-hmm. So obviously doing other stuff, but they had top-notch kind of mortgage-backed security research and fixed income research in general, incredible team. I mean, I think almost every one of those people ended up having an incredible career after that. It was just an amazing, amazing group, an amazing kind of incubator. And I was...
And this is what, the late 80s, early 90s?
Yes, this is 1988. I was there in the New York office from 88 to 91. And what I was doing was helping build mortgage prepayment models and writing research and all kinds of fun stuff. And then I transitioned, out of that into more of a sales research role, like engaging with clients and things like that. I lived in Philly for a year, Boston for a year, and then kind of made my way through the rest of the banks, like worked for Goldman Sachs for a while, worked for Deutsche Bank, worked for RBS Greenwich Capital, doing relatively similar things, like doing everything except for being an investment banker, right? I was trading, I was a prop trader, I was running quant teams. I almost always had some kind of technology team reporting to me because I had the computer science degree. So like, hey, can our computer science team for mortgages report to you? I'm like, okay, sure, whatever. And then, but obviously landed at Zip Brothers was my first gig on the buy side. And that was obviously baptism by fire, right? Mm-hmm. With 2008 and the financial crisis. And, I have to say that, we made it through there pretty well. And then on to Lord Abbett, where I spent a decade really starting their whole risk management function there and building out that team and doing all kinds of other fun stuff as well. So that's the short version.
Right. Well, I mean, and that makes sense, right? Because when you're trained in computer science, when you're kind of a natural coder, the first place you can kind of use your knowledge is where there's kind of more structure, right? And obviously fixed income and mortgages and so on and so forth is where the models come in with some degree of structure, and then you overlap what the data can help you inform, right? Things like prepayment. How likely is it that a particular pool of mortgages is going to get, repaid, prepaid before maturity, that sort of thing. And then, of course, when you and I met, and we were in risk management, that tends to be kind of the next step over, where a lot of it remains quantitative and analytical and data driven. And then some of it is like, how do you capture the stuff that we don't know? How do we capture the stuff that just doesn't fit in the model so cleanly, right? I mean, I remember kind of, talking about scenarios with you, and I seem to recall one of the scenarios was, a trade war. We don't have a lot of data points on how to kind of navigate that, right? So it's the application of technology and more of a liberal arts kind of mindset in a way, right?
Yeah. So I don't know if you remember this, but I had everyone who joined the risk team, both at Zip Brothers Investments and at Lord Abbett, read Thomas Kindleberger's Manias, Panics, and Crashes, right? I said, look, you should read the whole book, but at least read the first chapter, right?
Yeah.
And the concept was we want to reduce the risk of failure of imagination, right? Because in there are things like, oh, in 1857, every bank in Mexico went bust, things like that, right? And as we were looking down the barrel of that in 2008, I think we collectively, meaning the entire company, with strong encouragement from the risk team, had imagination for terrible things that could potentially happen that had never happened before, at least in the US, right? And I think that's one of the things that help keep us safe, because the question always is, you can't eliminate every risk, but you can mitigate them. You can mitigate them with hedging. You mitigate them with moving money somewhere you think is safer. There's all kinds of ways to do that. And I think, in general, everywhere I've been, where I've been focused on risk, we've done a great job in terms of imagining the bad things that can happen and having a plan in advance. Because sometimes it's not a matter of doing something, it's a matter of doing something before everybody else does.
No, I think that's exactly right. I mean, and it's funny because, again, I carry with me some of the lessons you taught me. One of them is failure of risk management is failure of imagination. And again, I love the concept of a pre-mortem, and I love the concept of having a playbook. And of course, everybody talks about postmortems, right? Something bad happens. Well, the bare minimum you ought to do is learn from it. The idea of a pre-mortem is before something bad happens, kind of talk through it and say, what could cause it? And importantly, how would we react? First off, would we be okay? And second off, how would be, what would be our kind of course of action? And the playbook thing, we had twins in Brooklyn, as you'll recall, and we would leave the kids at home with the babysitter, right? And one of the first things that, I don't know who told us to do this, but it was brilliant. They said, whatever the emergency kind of instructions are, print them in like font 50 and tape them to the fridge. Because when, your kid, your like baby is like bleeding, the babysitter will be in such a state of panic that if they have to go find the paper or make decisions on the fly, or by the way, they're like literally your vision. And again, we know this from living through crises in investing and being risk managers. Like in the moment, literally your whatever it is, your nervous system can take over, and like the phone number for the ambulance service can literally look blurry to you if it's not font 50, right? So that makes a lot of sense to me. And then the last thing, and again, this is, stuff that I really want to explore with you as well as all the other guests, is the intersection of the mechanics of investing and the psychology of investing. And I think somewhere in there you said something that's really important, and I want to dig in on the mechanics of investing. The plumbing can really matter, right? And you were saying, well, know where your money is, and all of that. Can you kind of get into that a little bit?
Yeah, absolutely. Look, I think that a lot of things break down in a crisis. And I can remember situations, for example, where we asked for a wire of money. I mean, big wires to go from one bank to another. And, they'd happen most of the time, but sometimes they wouldn't happen.
Yeah.
Right. And that's something that just, it's obvious that could happen. Right. But to count on everything for that one wire, that's a failure of imagination for sure. Right. So that's a very easy piece of plumbing problem. Another thing that happened that I saw happen during some of these crises were trades were broken. Like normally, if you're a trader, whether on the buy side or the sell side, and you would do a trade and it's recorded and all that kind of stuff, like you're done, you're good.
Yeah.
We saw the market saw plenty of trades broken, primarily because a company would be panicking. They would be selling things. They would sell something at a very cheap price. We'll just say 20 cents on the dollar. And to be clear, this is not anywhere I worked. They would then get another price from someone else 5 minutes later for 30 cents on the dollar. And they call the first guy up and go, yeah, I'm not selling it to you. Right. And they didn't care about their reputation or anything else because they were in survival mode. Right. So that's just something that in normal times, like kind of never happens. The other thing that's super important is funding. Right. So if you're levered at all, then at times, whoever's loaning you the money becomes in charge instead of you, right? And this is something we focused on a huge amount wherever I've worked and used leverage, right? Mm-hmm. Because that's what can kill you, right? If you have $100, you buy $100 of stocks, they go down to $70, and then 3 years later, they're $200. Guess what? You've got $200 worth of stocks, right?
But in the meantime, you control the timeline.
Right. You control what you are under complete control. If you got $100 of stocks and $20 of capital and the stocks go down to $70, you're out of business. Right. Yeah. So that's really the big difference. And I think that I think that having kind of really good borrowing agreements is important, meaning things like you can't change my terms for 30 days. Those are non-events in normal times and critical in crises. The liquidity could also take a hit as well. And I mean, even in the futures market. So I can remember a time when the futures markets were so crazy that the pits would not take limit orders. Now think about that. You're like, well, I want to sell some S&P futures or buy them. They literally would not take a limit order.
Have to be market.
Yeah, it would have to be market. And you don't know what your execution is going to be. No. And by the way, like you get what you get. Like there's nothing you can do after that. So all kinds of really weird things can happen during these crises in terms of the plumbing, whether it's bad execution or broken trades or funding getting pulled. And remember also that the large institutions in general are just applying things as a blanket. So here's a great example. During the crisis, there were a number of stocks that were short squeezed, right, during the crisis. And at times, those banks would change the margin requirements for those shorts, right? So, for example, your normal margin requirement might be 25% of the value you're short. By the way, today, it's a little crazy. We're going to 10x that.
Yeah.
Because just the volatility is so crazy. If you don't have an agreement with that bank that says they have to give you some kind of notice, like 30 days or whatever to change a margin agreement, like you're basically done. Like you can't afford that kind of margin and you're getting squeezed out of that position. So all these things
at a really bad price.
At the worst possible time. At the worst possible time, at the worst possible price, right? So plumbing does become important. And then you've got the whole crazy Lehman thing where they had all these different entities and it took them literally years after Lehman went bankrupt to figure out who actually owed what to whom and who would get what money and whose securities were actually whatever. And in the past, we've also seen situations where things that were supposed to be ring fenced or segregated, like customer funds, like just didn't happen. And it wasn't even malicious. It was just someone screwed up, right? So you're sitting there
And it
going,
got
I'm
commingled
good.
to something.
Right. Like, oh, I'm good. My funds are segregated in a bank account somewhere. Oops, maybe not, right? Because someone in the back office or the middle office just screwed up and put in the wrong account type. I remember that even JP Morgan, who's extremely good at this stuff, got a huge fine for commingling customer funds and not segregating funds. Like, this is probably more than 10 years ago. But still, you're like, what? JP Morgan? That's like the last place I would expect to mess something up like that.
And it's another one of those kind of assumption things, right? Where you really, most of the assumptions we use as shorthand apply 99% of the time. And then there is the 1% or the 0.001% in this case, right? We talk about the difference between a prime broker and a custodian, right? And of course, in your example, a custodian's job or a bank's job is to just know what money belongs to whom, to make sure it's in the right box. And right. And that's kind of it. That's the job. The job is make sure you know where the money is and that it can be assigned to the right person. But if you like, errors happen, weird things happen. And the last kind of the thing that goes back to where you started on this is, as much as this is a rules business, it is a reputational and a relationship business. And the economist in me wants to talk about things like backward induction and repeated games, right? Because we're going to have a relationship tomorrow, we should treat each other properly today. But the weird thing that happens in a crisis, right? And it's what you're describing when people are kind of like intentionally and I would argue callously choosing to break trades because they're not actually kind of keeping their word, that sort of thing, is like time has shrunk to zero. There is no tomorrow. They're just literally in survival mode. And they're saying like, what do I got to do to get through today and survive? But it can very quickly completely spin out of control.
Yeah, that's completely true. And we've definitely seen that movie before. And look, I think that it's also interesting in that institutions change over time, right? Mm-hmm. So when I worked at Goldman Sachs, it was a private partnership. I reported to a partner. And literally, I think every time I met with him, he said something like, the customer comes first. Goldman Sachs is long-term greedy, do the right thing for the customer, and eventually, we'll be fine, right? We'll make money. That changed, when they went public, basically, right? And I can remember a situation, and this goes to like the whole panic thing, right? Where a large investment bank came to a firm I worked at and was basically pitching like all these relatively sketchy, mortgage-backed securities, CMBS actually, and their deck showed how there's basically no way you could lose, right? This scenario you make money, that scenario you make money. And of course, what was happening was management of the bank was telling them, get this stuff out the door, sell it. We don't care who you sell it to, just get it out. We need to get it out. And what was interesting was these were fixed income securities being basically shown to equity people. Mm-hmm. By the time that's your game plan to sell something, you've got a problem, right?
Thanks for listening. I'm Jonathan Treussard, founder of Treussard Capital Management. I hope you're enjoying this episode. If you'd like to start receiving my free newsletter, Wealth Empowered, or if you'd like to learn more about me and Treussard Capital Management, go to Treussard.com. That's TREUSSARD.com. Thanks, and enjoy the rest of the episode.
Now, luckily, that happens to be my background, and these are my questions. At the end of their presentation, do you know who I am? Do you know what I used to do? Do you know I used to work at your bank? And then finally, it was a statement which is, as long as I'm sitting in this chair, we're not going to buy any of that. Have a great day. Right. So, but they were, people seemed kind of excited to buy it. So, it was a little bit scary. And obviously someone somewhere did.
Yeah,
right?
no, I mean,
And,
yeah. It's really, again, it's one of those things where knowledge can really be an antidote to kind of at least dodging some of the worst stuff. But some of it is just I mean, and obviously in your case, it helps. And in my case, it helps to actually understand these things deeply. But then as a basic rule of thumb, when someone tells you like, hey, this deal used to be not for you, but now we're making it available to you, like run, you're like, why? Tell me more about this favor you're trying to do me.
right.
And I think it's happening. It's happening in a lot of spaces. Some of it is people get desperate. And I think sometimes they want to believe their own stuff, right? Where you could have this weird misguided notion, right? That, hey, in a world where things are going to go badly for equity investors because the whole system's at risk, at least with the mortgages, you have a sense of downside understanding. I mean, it's just people kind of talk themselves into kind of rationalizing their private actions.
Yeah, look, you go back to Charlie Munger, it's all about incentives, right?
Mm-hmm.
Like, so if you're a salesperson at one of these big investment banks, like, you know exactly what you get paid for everything that you could possibly do, and you focus on the things rationally, which you will get paid the most to do, right? Yeah. So probability of completing a sale times amount of money I'm going to make, right? So that's very clearly why they were running around doing that, besides the fact that their bosses were probably telling them, like, you're all fired if you don't sell
this out of here
stuff, right?
Yeah.
So a little extra incentive. But yeah, I think, look, a lot of wacky things happened in markets at that time. I think a great example was in the mortgage REITs. So this is kind of a very little known space for most stock investors. What's a mortgage REIT, right? Well, they buy mortgages or real estate and even agency mortgages, and they lever them and then they hedge them, right? And so you're basically buying a mortgage and then selling, treasury futures or something like that, right? The idea being that if interest rates fall, you make a lot of money on the mortgages, you lose some money on the treasuries, but all in all, you're going to make money, right? And you're earning a huge yield on the mortgages versus the implied cost of carry of the treasury futures. Well, what happened during one of the crises? The price of both things went the wrong way, meaning they lost money on the mortgages and the treasury futures went up in price. They were short. And so they lost money on the futures, on their hedge. On the hedge. So
yeah, because these things aren't always mechanical.
That's right. So the first time they've never seen this before, they're sitting there going like, wait a second. Both things are down. We just lost, whatever, X% of our capital in 5 minutes, right? Like,
and by the way, we're levered.
Right. And by the way, we're levered. Yeah. So super scary time. No, a lot of the mortgage REITs kind of didn't survive, that period of time.
Yeah. No, I mean, I think people don't understand that in terms of, different grades of fixed income and the concept of a spread. And that, you really have two things. You have the baseline interest rate that's kind of guiding the whole economy, and then you get the thing on top. And in a crisis, you can easily see interest rates come down and spreads kind of blow out. And where does that leave you? So all of that.
Yeah, historically, it's really been you need a credit rating of AA or higher on a corporate bond for it to actually make a significant difference and rally during a recession, because the high yield bonds, for example, during a recession are actually going to end up having higher yields because they become more risky even as interest rates fall.
Yeah. All right. So we've talked a lot about wacky things we've seen on the mechanical side of things. On the way out to the new chapter in your life, anything wacky you've seen from just a pure psychology thing in markets?
Yeah, I think the meme stock thing is just fascinating, right? So you've got people that literally don't know anything about investing. They're probably even bad gamblers. And they go on Reddit and read something about a stock and just go put their life savings into it. I'm like, it's just like unbelievable, right? In addition, you've got, videos out there of people like touting various investment strategies or things which are just blatantly wrong. And if they are executed faithfully by the watcher of the video, will eventually bankrupt that person, right? So it's just like this crazy, crazy stuff where, and I don't think people believe everything they're saying on those videos. I think they're doing it to get attention.
Yeah.
So that's part of the psychology. I want to get lots of attention. I've got 1 million viewers of my options video blog or whatever. Yeah. And then guess what? Like the real people are losing their life savings on this, right? That is just crazy. So part of it is, why are people crazy enough to want to say dumb things on video that are provably not true?
Right.
And then why are people believing them and dumping their life savings into it and losing everything? I don't get it.
Yeah, they want to believe. I mean, again, it's to live in the world as it is often kind of a bummer of a place, as opposed to for a period of time, right? Thinking the world might kind of live by your rules. I mean, it's just, I think, the world as it is versus the world as it should be. It's a real problem. But, and again, to your point, I think it's the issue of incentives, and it's the issue of externalities. If you're getting paid for eyeballs, you'll maximize eyeballs. And the fact that, someone somewhere out there might not be able to make the mortgage because of your actions, you're not suffering the consequence. So you did everything that we just talked about for a very long time. And then recently you went back full circle to computer science. Tell me more about that.
Yeah. So super interesting origin story. So I retired from Lord Abbott, end of 22. In 2023, I played over 100 rounds of golf, which was fun. It got my index down pretty far. Still play a lot of golf. And then I was watching these big companies adopt AI with like no guardrails. I'm like, this is crazy, right? Like, not only is it bad for these companies, but it's bad for their customers, bad for their employees. I'm like, this is nuts. Now, you got to have...
What could possibly go wrong?
Right. What could possibly go wrong, right? Like, just because the AI has access to all our data and the nuclear codes, Jonathan. Right. So actually, I got to do a quick segue, which is there's this incredible, I think it's a Gary Larson cartoon where it's a video and there's a bunch of generals and admirals and obviously what's a war room and there's a bunch of computer screens. There's an Alexa on the table and all the computer screens saw all these missiles, launching, right? Like, heading in the atmosphere. And the general is yelling at Alexa going, "No, Alexa, I said order lunch."
That's so good.
I'm like, yeah, that. Anyway, so I basically put my computer science hat back on and said, you know what? I'm going to write something that does AI, governance, risk management, regulatory compliance, and cybersecurity. Let's see if I can get it to work. So I taught myself Python, which isn't that hard because it's a pretty easy language. I was using ChatGPT and GitHub Copilot and all kind of like the tools available a couple of years ago, which were pretty good and kind of probably saved me 50% of the time in terms of development.
Wait.
Back
So
then.
you did know Python, and back when you and I were working together, I would be like, look at my MATLAB code. So were you just kind of going along for...
No. I'm saying I know lots of code, but my point is I had to teach myself Python.
I know.
As opposed to the other 8 languages that I know, because it's easy to template things in Python, right? So, and a lot of stuff's free. Like, oh, I need a free SQL library. Great, done, right? Like in 5 minutes. So that was my point. So anyway, using all these different tools, built it out, got it to work. I'm like, holy shit. So anyway, I called up a friend of mine, Frank Fitzgerald, who's now my co-founder and CTO at Artificial Intelligence Risk Inc., showed it to him. He said, oh my God, you're right. These banks are crazy. Like they need this stuff. Let's do it. We went very quickly from kind of proof of concept to demo to beta to enterprise version, which we launched last September. And now we've got, 20 paying clients, people in our trial program, all that kind of stuff, and just going to the
Amazing.
moon. It's pretty awesome.
Yeah.
So that's how it started.
Oh, I love it. And again, it's one of those things where a lot, and by the way, I think it goes back to your point about the crazy psychology of people doing things that are blatantly against their own best interest, but they just don't. And I understand that kind of pressure, right? If AI is all you hear about and you're a public company or a bank and you're getting punished every time there is a quarterly earnings call because you're not doing enough AI, at some point people say, let's just do something, right? Without recognizing the potential implications of doing something that isn't kind of ready for prime time. So you're kind of bringing that whole kind of knowledge set of thinking about best practices in terms of risk, best practices in terms of compliance, which of course you lived in the financial industry for a long time, which is a little bit under the umbrella of regulation, and importantly, just kind of thinking about the corner cases, right? How could this go badly? I mean, I love the story, and I think this is a story you might have told me a few years ago now of the car dealership that rolled out that customer interaction bot, and then within 2 prompts was told, your job today is to sell me a car at a loss. Go. Right? And,
right. Well, it's
and
actually people buying cars for $1. Yeah.
Amazing, right?
Yeah. Oops. Bad job.
The power of a prompt. So that's really cool. And obviously we'll put in the show notes your the website and all of that, but just to have it on the record, if people want to learn more, where should they go?
Yeah, you can go to the website, which is aicrisk.com, or you can look us up at Artificial Intelligence Risk on LinkedIn. We've got lots of fun content and newsletters and great stuff there.
That's cool. That's very cool. Well, I love following along, so this is very good. All right. On the way out, are you ready for some questions?
Sure.
All right. As a Frenchman, I've decided to go with the official Bernard Pivot list of questions.
Oh, sounds great.
Which, of course, were adapted in the American world by Lipton on the Actors Studio. But this is the official original series of questions. What is your favorite word?
Accelerate.
Nice. What is your least favorite word?
Sludge.
We can see a theme there. What is your favorite drug?
Caffeine.
Nice. What sound or noise do you love?
Guitar.
Excellent. I like it. What sound or noise do you hate?
The subway squeal.
What is your favorite curse word?
Yeah, I have to say that I didn't use it on the show, but I do drop the F-bomb occasionally. So.
I've heard it. Who would you like to see on a new banknote?
I don't have any particular pick there other than how about fewer politicians?
I like it. What profession other than your own would you not like to attempt?
Well, one of my wife's cousins is literally a tiger tamer, and I would not want her job.
Got it. If you were reincarnated as a plant or an animal other than a human, what would it be?
Oh, definitely eagle. I like flying.
I like it. And finally, if heaven exists, what would you like to hear God say when you arrive at the pearly gates?
You will see your wife eventually.
I love it. Well, this was fabulous. So much fun. Thank you for doing this. Any final words on your side?
Yeah, this has been great. And look, I think a lot of crazy stuff is going to happen this year, right? Politics, markets, AI, all that kind of good stuff. And I think it's important to focus on the long term, right? and focus on what you can control and not stuff that's out of your control. Because it's very easy to spin yourself up and do nothing, get really upset. Do what you can, right? And stay safe.
Alec, I love it. And thank you so much for today.
Great to be on the show. Thanks, Jonathan.
This podcast is for entertainment and education only. Nothing here is financial advice. Treussard Capital Management is a registered investment advisor. Please visit our website, www.treussard.com, for additional information and disclaimers.